The United States stock market is currently closed, and as of the final bell of the latest trading session on July 15, 2026 at 4 p.m. Eastern Time, NUBURU, trading under the ticker symbol BURU on the NYSE American exchange, officially closed at exactly $0.1199 per share, representing an intraday decline of 4.99%. For the typical retail investor hunting for an online investment opportunity, seeing a company trading at roughly 12 cents usually sets off immediate warning bells of an imminent bankruptcy or terminal decline. But if you peer past the surface-level numbers, a fascinating paradox emerges that completely flips the standard market narrative on its head. On the very same day the stock price slipped down toward its recent historical lows, management announced the closing of a massive $38 million public securities offering that was led by a sophisticated New York-based single-family office alongside several prominent accredited investors. What makes this development truly startling is that the combined public offering price was set at $0.1555 per share, representing an approximate 30% premium over that actual public market closing price. When a microcap firm secures institutional backing at a price significantly higher than where the open market is valued, it creates a massive structural mismatch between public expectation and underlying institutional reality, forcing anyone engaged in online investing to pause and completely reevaluate their thesis. The common ground among market spectators is that microcap stocks trading under $1 are nothing more than speculative lottery tickets, prone to sudden dilution and erratic swings that wipe out retail accounts. If you open up a standard individual brokerage account or check your daily alerts on a popular app, you are trained to look for steady, predictable gainers. Most people using modern investing sites look at the massive daily trading volume of over 33 million shares on NUBURU and assume it is just day traders passing a volatile asset back and forth. The general consensus is that this company has historically struggled with a multi-year balance sheet deficit and has had to rely heavily on equity lines of credit that continuously dilute existing shareholders. It is easy to look at the chart, see that the stock has crashed from a 52-week high of $4.24 all the way down to 12 cents and decide that it is an absolute trap. This point of view is exactly what the mass market believes, and in many ways their caution is justified by historical data. However, the contrarian take requires looking at what that $38 million capital infusion is actually designed to accomplish, because it shifts the business from a struggling hardware manufacturer into a highly structured defense contractor, completely upending how the company will generate revenue moving forward. To truly understand the internal mechanics of this business, we have to look closely at where this new capital is going, rather than just focusing on the downward pressure on the stock chart. According to the official registration statements filed with the Securities and Exchange Commission, NUBURU is targeting specific balance sheet cleanup maneuvers that will eliminate the structural drag that has plagued their equity valuation for years. Specifically, they have earmarked $15.5 million to fully redeem the remaining principal amount of their December 2025 debenture liabilities, which were originally set to mature in December 2026. By wiping this debt out completely, they eliminate the aggressive recurring stock-based amortizations that have forced a constant supply of new shares onto the market, which was the main culprit behind the absolute collapse of the share price. Furthermore, they are allocating $1.25 million to settle the remaining convertible promissory notes connected to their previous acquisition of Liacon. For an independent investor managing their own portfolio through self-investing, identifying these inflection points where toxic financing structures are removed is often the difference between catching a bottom or getting caught in a falling knife scenario. It is a highly technical shift that automated tools like Schwab Intelligent Portfolios or a standard robotic wealth manager would typically miss, because automated algorithms look at historical financial statements rather than forward-looking debt extinguishment events. The real core of the thesis, and the piece that is causing massive institutional interest from family offices, is the pending acquisition of a 70% majority controlling interest in the Italian defense and security firm known as Tecna SPA. This transaction has been delayed because it requires satisfying strict financial assurance requirements associated with Italy's rigorous Golden Power regulatory examination, which monitors foreign investments into critical national infrastructure. A major portion of this new $38 million capital raise is explicitly dedicated to fulfilling these financial guarantees so the company can finally obtain final regulatory clearance and close the transaction. This is not just a minor expansion, it's an aggressive structural pivot that repositions the firm from a pure-play industrial blue laser vendor into a comprehensive next-generation dual-use defense and security integrated platform company. Management has explicitly projected that this Italian defense business segment alone targets approximately $336.3 million in gross revenue from 2026 through 2029, based on their current opportunity pipeline. If they can successfully convert these institutional relationships into binding contractual orders, the revenue generation could dramatically outpace the current microcap market capitalization of around $20 million, making the current 12-cent valuation look incredibly mispriced in hindsight. Please take a moment right now to participate in our channel discussion by dropping your thoughts in the comments section below. Comment below how many shares of NUBURU you currently hold in your portfolio, or share your thoughts on whether you think microcap defense pivots are too high risk for a standard self-directed individual brokerage account compared to holding stable blue-chip companies. Getting your feedback helps us gauge how the retail communities are allocating capital to these microcap tech plays. When we look at how the average person approaches the market today, they often stick to megacap names, tracking the daily movements of Tesla stock, checking the options chains on Apple stock, or following the massive institutional momentum behind Nvidia stock. These massive names dominate the headlines and form the core of most portfolios held within Fidelity Investments or managed through a standard Fidelity brokerage account. But when you're looking for outside asymmetric returns, you have to look outside the comfortable confines of Fidelity mutual funds or the most popular Fidelity ETFs that track the broader indexes. A stock like NUBURU requires a completely different analytical framework because its survival and subsequent growth depend entirely on micro-level regulatory approvals and corporate restructuring rather than macro-level consumer spending trends. Investors utilizing a comprehensive Fidelity trading platform or reviewing their holdings via the Fidelity mobile app must treat this as a venture-style bet rather than a core long-term investment asset, requiring a dedicated pocket of capital separate from their main Fidelity wealth management goals or conservative Fidelity IRAs. If we look back at the actual operational performance reported in their first quarter financial results for 2026, we can see the very early signs of this structural turnaround starting to materialize. The company reported a total revenue of $407,644 for the first quarter of 2026, which might sound small, but it represents a massive shift considering they had absolutely zero revenue in the first quarter of the previous year. This initial commercial traction was driven primarily by $344,365 generated through their Liacon subsidiary and $67,279 from Orbit. Even more impressive was the massive reduction in their net losses. The net loss for the first quarter of 2026 was narrowed down to just $459,898 compared to a severe net loss of $16.61 million in the first quarter of 2025. This means management has successfully chopped down their operational burn rate and structural inefficiencies by over 95% in a 12-month span. Additionally, their total asset base expanded significantly to $76.15 million as of March 31, 2026, up from $49.82 million at the end of 2025, reflecting the consolidation of their new acquisitions. This operational improvement allowed them to report a positive shareholders' equity of $2.17 million, dramatically reversing a multi-year shareholders' deficit of $15.18 million. This dramatic $17.35 million balance sheet repair was a necessary milestone to satisfy the NYSE American Exchange's compliance listing tests and avoid getting delisted to the over-the-counter markets. For investors who use retail-friendly platforms like the Robinhood app or engage in active Robinhood stock trading, microcap equities like this present a severe psychological test. On one hand, the availability of Robinhood fractional shares and zero commission structures makes it incredibly easy to take a small speculative position without risking a massive amount of capital. You can easily manage your Robinhood